December 9th, 2024. If you'll notice, I'm writing a little bit less on my slides now than I was a little bit ago because I think that I'm trying to do a little bit of a better job just highlighting the bigger patterns. And the bigger patterns that we had today were consecutive sell climaxes, 1, pullback, 2, pullback, 3. So we had consecutive sell climaxes on the open, a head and shoulders top, trying to get trend resumption around the middle of the day, 41, 42. Trend resumption ended up failing, and we got a reversal up, but the failure failed. So you have a failure of a failure, and then we got a surprise to the downside and a little bit of a trend. In general, when you get a failure, obviously traders look for an upside breakout. And then when the failure fails, that's usually, a good sign that it's a little bit more likely that that's going to work. Simply because the market can only fail so many times, especially when it's getting these large bars, 47, 48, 49, 50, etc. Then good looking bars down, 53, 54, 55. So the market, failure of a failure is usually a pretty reliable pattern. Bar 1, a bear bar. You can see, if you look at yesterday, 1 is trying to create a head and shoulders bottom. We have the left shoulder, the head, the right shoulder, so head and shoulders. And really all that means is it's a lower high or lower low major trend reversal. Here's the trend line. We have the break and then the pullback to the new lower low. But lower low major trend reversals usually have to form higher lows. So in the beginning of the day, the bulls were trying to form a higher low and get a bounce. 2, an inside bar, a doji bar, probably sellers not too far above, probably buyers not too far below. Not really much to do here. 3, buyers below 2. 2 was an inside bar and a low 1 short at the bottom of the trading range, so really not all that great to be selling. Probably sellers above 3, willing to scale in higher. So rally above 3 during 4, but do you really want to sell, or do you really want to sell, a point or two above 4 or above 3? Maybe, but it's tough at the bottom of a trading range. Do you really want to buy the close of 4 after 3 straight bear bars? No, definitely not. So probably, I think, better to be flat here. There's not really a rush to do anything. It's probably just better to wait at this point. 5, an inside bar, probably buyers not too far below, scaling in lower, probably sellers not too far above, and then consecutive inside bars 5 and 6. This is it's a triangle on a lower time frame, so you're expecting that we're going to get some sort of breakout at some point. Again, the daily range at this point is 6 or 7 points, so there's really not a reason to be forcing yourself into the market on bar 6. You have 75 bars to make money. You don't need to be forcing yourself in this early. Sellers above 6 during 7. And 7 is essentially a low 2 short. You could look at it that way. The low 1 below 4. It never triggered though. And low 2 below 7, but it is kind of a second attempt down. And then 8, a bear bar closing near its low. It's a possible high of the day. So you could, in theory, you could sell below 8, or you could just wait for follow through. Me personally, I waited for follow through. I think that 7 is a lower probability trade, and you are selling reasonably low in a trading range. If you do sell below 7, you have to have reasonable calibrated expectations for what the trade is going to do. If you sell below 7, what do you want to see as follow through? Or sorry, 8. If you sell below 8, what do you want to see as follow through? And 9 probably isn't it. Yes, the trade ended up working, but I think it's just that sort of stuff can make the trade really difficult because a lot of times traders, if they sell below 8 and they see 9, they'll buy back their short around the 8 low, and that'll cause a bounce. So it's not wrong, obviously, to just sell the close of 8, put a stop above 7, and just sit in the trade and try to make 5, 6 times your risk. But you're going to lose a lot if you do that. So it really depends as to what you are looking to do. 9 does go below the possible head and shoulders bottom, so we are probably going at least a little bit lower. 10, a bear surprise. A tail on the bottom. It's possibly forming some kind of wedge, but probably buyers down here willing to scale in lower. 11, an inside bar, a low 1 short. So what's happening right now, right? What are you saying if you're selling below 11? Well, you're saying that 7 is probably the high, or sorry, I keep saying 7. 8 is probably going to be the swing of the day, and 1 is essentially probably going to be the high of the day. You're hoping for a collapse, right? If you're selling below 11, you're not looking for a follow through bar like 9. You're selling a low 1 short, potentially low in a trading range. Remember, most days are trading ranges, most days are trading range opens, and this could be a trading range open. And if it is a trading range open, then the sell below 11, a low 1 at the bottom of the trading range, is probably not going to be all that great. 12, a bear surprise bar, so a sell climax, but a large tail on the bottom. Good for the bears. We're probably going at least a little bit lower, but usually when you got a sell climax, I like to get a good looking bear bar after that in order to short. And then 13, an inside bar, a low 1 short, a bear bar closing near its low. It's reasonable to sell the close of 13 and look for some sort of follow through. Again, low 1s generally lead to pullbacks before they lead to follow through. So again, I think it's okay though to sell below 13 and look to get 14 to 15, whatever, some sort of bear follow through. More follow through for the bears on 14. A large tail on the bottom, indicating that we're probably going to pull back, but I'm not sure how far we're going to pull back. Pretty easy short above 14 if you're a limit order trader after five straight bear bars. There's going to be sellers above 14 willing to scale in higher. 15, a low one short for the bears. Again, probably buyers not too far below, but we're probably going to go at least a little bit lower. It is the second leg down too. The first leg went above 14 and then back down 15. 16, a bit of a sell climax. We're probably, again, going a little bit lower, but I would imagine buyers somewhere below. 17, disappointing. Or sorry, I think 16 is what I meant to say on the past one, but 17, a doji bar, a little bit disappointing, but it's okay to still be short. No one's going to be willing to buy above 17. 18, an inside bar, probably sellers above, but once we trade above 18 and we go back below, what is it now? Now it's a trading range. Now it's a third leg down. So do you really want to trade third legs down? No, it's really not that great to be trading third legs. So for me, it's hard to want to short to do anything other than start looking to get out of shorts, because there's probably traders willing to buy somewhere in this area on the third leg down. And that's the same reason it's not great to sell below 20. It's more okay to sell far below the moving average if you're convinced you're getting a first leg, but if you just count the legs, it's pretty clear that 20 is the third leg down. So you're going to need really, really major follow through. In general, if you're going to sell a third leg, you want the third leg to not be a third leg. You want it to be a breakout. So, it's kind of a trick question to say in general when you sell a third leg, because you never really want to short a third leg. If you're selling a third leg, you're hoping that it's more of a major breakout and that it's not actually a third leg, it's a first leg, if that makes any sense. 21, a bull bar closing near its high. It's good for the bulls, but that it's going to be a minor reversal. The sell-off down to here was really, really strong. So it doesn't mean that we're not going to go higher. It just means that if we do go higher, we're probably going to try and form some sort of topping pattern and then come back down to the downside. So 21, a bull bar closing near its high. Bulls probably going to be willing to exit above 21. The bar 20 close is a magnet for later. So the bears know that they can sell any bear bar, and if they're willing to scale in, maybe more around 50%, they'll probably end up making money. I don't know if this went to 50%. Okay, so not surprising that we rallied to around 50% and ended up reversing that area. 22, consecutive bull bars. No one who is short really is a big fan of 21 and 22. It means we're probably going to get at least a little bit more to the upside. 23, a third straight bull bar. So 21, 22, 23, good for the bulls, but shrinking bodies. 24, four straight bull bars, so 21 through 24. Yes, we're going a little bit higher, but we're going to touch the moving average for the first time today. So they'll probably be sellers somewhere up in that area. 25, another bull bar. So 5 straight bull bars, but not closing above the moving average. At this point, the moving average is more important than, essentially the bull price action is. 26, a big bear bar, a tail on the bottom though. So are there buyers here? Probably more buyers than sellers, since 21 through 25 was so strong. So that there's probably going to be traders willing to buy the close of 26. Are they buying it thinking we're going back to the high of the day? No, they're buying it for a scalp, thinking we're probably going to go at least one tick above the bar 25 high, since the rally to 25 should get a second leg. An inside bar, a high one buy essentially on 27, but really not that good. It's a doji bar. 28, probably sellers above. So at this point, what are you looking for? Let's forget the bar by bar price action for a second and think about what are you looking for? Well, for me, what I'm looking for at this point is essentially what I'm looking for is a reversal back down around bar 40. In general, if you get a sharp sell-off, I think this is a really important thing to note. So I would personally write this down if you don't already know this. But I think in general, if you get a really sharp sell-off or a really sharp rally early in the morning that lasts between bars, 18 and 22, something in that range, maybe 17 and 22, you should look for a trend resumption around bar 40 to 42, because that's around the middle of the day. And midday reversals are pretty common. So does that mean the trend resumption is always going to work? No, it might fail like it did today. But I think 42 was a pretty solid short looking for trend resumption. But we'll talk more about that when it gets there, because the calibrated expectation for selling below 42 is that you're going to get really good follow through. So 29, a bull bar, but probably sellers above 25 during 29. 30, 3 straight bull bars, large tail, 28, 29, 30. So probably sellers somewhere up in this area. 31, a bear bar closing near its low. We are always in short, probably because of how big the sell-off was. It would take a lot for me to for the bulls to convince me that we're always in long. So 31, a bear bar closing near its low. You could short below 31, looking for a measured move down, a second leg down. But the rally from 21 to 30 makes me unsure if I would like to sell in this area. Probably more sellers at the 30 low. 32, a bull bar, but a third leg up for the bulls, so really not that good. First leg 25, second leg 30, possibly third leg 32. The third leg ends up being around 40. 33, an inside bar, a bear bar closing near its low. Can you sell below it? Yeah, you can take the short, but it's not really all that great. It's a low one short and, kind of in a trading range area. 34, follow through for the bears, but pretty minor at best. 35, another bear bar, but a large tail on the bottom. So the bears are hoping to get back below the bar 20 close. They're going to look for the market to collapse, and it probably isn't going to collapse. 36, a bull bar, but not really all that ideal of a place to buy. Again, I'm looking for bar 40 here, and I'm just basically looking for the next bear attempt down, somewhere between bar 38 and 42. And I want to see if it fails. 37, an inside bar, a high one buy, probably buyers not too far below, probably sellers not too far above. 38, a good looking bull bar, but we've only had one bull close above the moving average so far today, so probably sellers somewhere up here. 39, two straight bull bars, but a large tail, not that great, but buyers below 39, and 40, a bull bar closing near its high. And then you get 41, the head and shoulders, left shoulder, head, right shoulder. 41, bear bar closing near its low. You could sell below 41, but the tail might keep some traders out. Some traders would prefer to wait for higher probability, and 42 is your higher probability. So a bear bar closing near its low, 42, you can sell below. What do I mean when I say the calibrated expectation for 42 is you get good follow through? Well, you can't just sell 42 and sit in the trade and let yourself get stopped out. You have to think about, if I'm selling below 42 and this trade is to work, what should it look like? What will probably happen if this trade is going to work? And what will most likely happen is that 43 is good looking follow through, and same thing with 44. So I think that probably not going to collapse. Or sorry, if this is going to work, it will probably collapse below 42, or 43 will at least look something like 31. Instead, you get a disappointing bar on 43. Give me a second. Some bears buy back shorts immediately on the close of 43, but I think it's reasonable to wait to see if 44 is another bear bar. It's still a 3-bar micro channel, and sometimes 44 will be a big bear bar closing near low. But instead, disappointment on 44. So probably traders looking to buy back shorts, and that's what's happening on 45. It's not really great to sell below 44, so traders are buying back shorts on 45. A doji bar 46, a low one sell, but not very good. Again, if this was going to go, 42 is supposed to be a high probability setup. You're expecting probably 60% chance that we're going to get some kind of follow through, maybe a 50-50 chance of a swing down. And if you're not getting that 44 or 45, then a lot of traders start to exit, and that's what's causing 46, 47, 48, basically causing the rally. We should get back to at least a bar 40 close after this 3-bar micro channel. But the real question becomes, if we do break out above the above the head and shoulders, what's the profit target? And I think that the bar 11 low is the swing point. It wasn't necessarily a high probability. It's decent probability because reasonably good bars, but you're still selling a low one short if you're selling below 11. So low ones often get tested, and you can see we didn't even test it. And so I thought that might be the target. Obviously, it did not end up getting there. 50, a bull surprise. In general, with these, my setup is these 4-bar sell climb, or 4 bars for the bears or the bulls. So when I saw 10, 11, 12, I thought good follow through for the bears, but 12 is climactic, so I want to see one more bear bar and then I'll short. And I got 13, so I sold the close at 13 for a measured move. And then over here, I saw buy climax 50, not quite breaking out above here. So I wanted one more bar 51, and I bought the close at 51. I didn't necessarily think this was high probability. I think that usually something like this is going to get another leg up. And I'm trying to be careful. Well, I am careful, I'd say, about buying third legs. And I did not look at this as a third leg, or this as a third leg from anything in here. I thought this was a head and shoulders. And I thought that this was a breakout above a bear flag. So I thought that that was a pretty reasonable thing to do, to buy up there. There's a couple ways you can exit. I'm still basically doing always in exits. So the market basically is going to force me out. I did end up getting stopped out below 47. So I was relatively break even on the day, but you can exit below 53. The problem is if it starts to rally again, how are you going to get back in? A simple way to exit your trades, if you'd like to, is you can exit when, let's say, if you're long, let's say whatever, you buy the close of 50, 51, and then you get 53 at bear bar closing near its low. It's possible that that is going to be the start of the second leg down from the move from 8 to 20. I just thought that usually if we're going to get a big second leg down from this, it probably would have happened here. But still, 53 is going to get a second leg down. It's very likely. So some traders will just exit below 53. 54 consecutive bear bars, and sometimes 55 will be a decent bull bar. It will go sideways, get a second leg, and then get trend resumption. Instead of that, bulls gave up. And so 55 is the give up bar for the bulls. And that's the bar that traps a lot of bulls who are buying maybe around a 50% pullback, hoping for a bounce back up to this close. They get trapped out on 55. Big bear bar closing near its low. 56, a bull bar with a good looking close. Leo's on 56, a bull bar, but sometimes 30% of the time the market goes, when you see a really strong breakout in general, 80% chance you're going to get a second leg, and 80% chance the market's going to pull back. 30% of the time when you get some sort of spike, like a bull spike like this, you're going to go below the low before you get a second leg. But you can see here, we went below the low and we just kind of never got the second leg, which is low probability, but certainly happens. 57, an inside bar, low one short. We didn't trigger above 56. You could sell below 57 and just take a chance, probably stop above 56 or, maybe a couple points above, maybe a stop above the sell climax 55 high, depending on if you're willing to scale in or not. 58 consecutive bear bars. It's a really tight channel down, so obviously there's nothing to buy. You're not buying here, you're not buying here, you're not buying here, and you're certainly not buying here. I get that it's attractive to try to buy early in a buy the close finish, but if it's going to be a buy the close finish, you're going to get 4, 5, 6 bars. So it's better to buy after 2 or 3 and only catch 1 or 2 bars than it is to buy after 1 bar trying to catch 5, but just losing all the time. 59, a bull bar closing near its high, probably sellers above. 60, so we do get the sellers above. And then 61, 62 consecutive bear bars. It's possible a third leg down, 1, pullback 2, pullback 3, and then a breakout 63 with a follow through bar 64. I did not sell this. I thought about it. I was really considering it, but I ultimately decided that it was too likely that it was third leg, 1, pullback 2, pullback 3, and we were in a pretty obvious support area, the possible bottom of the trading range. So I didn't know if we were going to go more sideways. If I'm selling the close of 64, I'm putting my stop above 60. I'm trying to make 5.75 points while risking 7 points. So I don't know. I did not take the short. I think I'm pretty okay with it. But that was something that I did consider doing. But ultimately, if 65 was a bear bar closing near low, I was just going to sell that close. But we got a pullback on 65, and then 66, another bull bar. So that was disappointing as well. And that was pretty much when I decided to walk away for the day. I thought if 67 was a bear bar closing near its low, there was a chance of a sell to close finish, and we were going to get a breakout below the 3 legs down. 3 legs matters less in trends, but I wasn't super convinced this was a trend. So you could sell below 67. I wanted to close on its low and get good follow through, but it did not close on its low, and disappointing follow through 68, 69. So again, you can be selling. You could have been selling any of this, and you did get some follow through, but again, it's just really difficult to hold short because the market's constantly looking like it's going to reverse. And again, you don't really have to exit for any reason, but these were just difficult trades. So for stop orders, you could sell below 8, 11, you could sell to close. This is all sell to close all the way down to 16 probably, but 16 is a little bit sketchy. And then 20 is not sell to close. It's a third leg down, a sell climax. Maybe you could buy above 21, but it doesn't close on its high. None of this is all that great. It's a minor reversal. I thought 41 and 42. 41 is a good trade. 42 is probably the best trade of the day. It just didn't work, which is fine. Then we got a rally. I thought it was okay to buy in here, taking a chance we got a rally back up into this area, and then a surprise 53. You can exit below 53. I probably wouldn't sell. There's too many bull bars, so I probably personally would not sell. If you do, your expectation is that we're going to basically do this, right? So I would, if you like to take trades like this, I would, this is a perfect example of a low probability trade that's going to work when it gets 54, and especially the give up bar on 55, you're going lower. So this is what you want to see if you're going to take the short. You can't be taking low probability trades and having them go sideways for a bunch of bars. That's really not that great, especially in a situation like this where you have a big bull micro channel. But sell to close all through here. You could sell the low one if you wanted to. Expecting the second leg. I thought it was reasonable to sell below 1 or the follow through. Any of those is fine. The 15-minute chart, you can see, and the same thing happened with the 15-minute chart that I talked about with the 5-minute chart. The setup of those 4 straight bear closes. We got them here, 1, 2, 3, 4. But again, you have to be expecting a deep pullback. So I still think odds are we probably go down here because this is a trade within my system is to sell this close and look to get a move down here. So I still think it's reasonable to be short and probably going lower, but obviously sometimes you have to sit through deep pullbacks. For limit order trades, there's a whole bunch of stuff you could always do in limit orders, obviously, but selling above 14, let's just say that's your best trade of the day. Why is selling above 18 worse than selling above 14? Because this is a first leg and you're selling for a second leg. This is a second leg and then you're selling for a third leg. So you want to be selling first legs for second legs, not necessarily second legs for third legs, etc. On the daily chart, the bell's about to sound, so just bear with me for a second. All right, there we go. So probably buyers not too far below here, right? Would you be eager to sell below this 12.6 bull bar? Probably not. So I would imagine they're going to be buyers. Maybe not directly below the bar. We could get a quick vacuum test of the moving average, but probably going to bounce somewhere in this area. On the weekly chart, 3 straight bull bars. If we go below last week's low, I would expect buyers. And the monthly chart, obviously a climactic bull bar closing near its high. Do you think that the next bar is going to look like this? Probably not. So if this starts to fail and becomes a bear bar, we're probably going to test, I think the October high is a reasonable target if this starts to fail. Obviously, if we just get to start to rally and we get a good looking bar that looks like this, then we'll probably go at least a little bit higher. My throat's really dry today. I'm not sure why, but all right, that's going to be it for this video.